I truly believe in gold as a monetary asset, not as a keepsake, not necessarily as a speculative plaything, although to be sure it does serve that function as well. But I believe in it as money that will, if not supplant, then at least will keep company with present day paper currency.
Greetings and welcome to our show. Today we're with Jim Grant, the editor, author, publisher of the eponymous Grant's Interest Rate Observer. My name's Trey Reik from Bristol Gold Group. How are things doing in the Big Apple today, Jim?
It is sunny and cold, unlike the gold market, which is sunny and hot.
And unlike the friction of the Trump presidency, which is very hot.
Yes, it is, yeah. You almost think he wants to start a little bit of trouble.
Yeah, can you believe that? Well, you've been writing 12-page reports 24 times a year for 40 years.
42.
So my 42?
42, yeah.
There we go.
So going on 42. I like to, yeah.
So that's something like 12,000 pages. And I think over time, some of us have been exposed to grants for so long that we fall into the trap of perhaps taking it for granted, taking grants for granted, if lack of a better phrase. And I'm here today, at least in part, to encourage people not to do so. And we wanted to explore a little bit what grants still has to offer and what it continues to offer. So in that regard, as you look back over the 42 years, how would you summarize what you believe Grant's mission has been, and how do you think you've done? What's the value added of Jim Grant?
Oh, my goodness. Well, we are in business to imagine the next thing. And to that end, we try to apply the tools of financial analysis and a little bit of history. And there are half a dozen of us in this room, so we can hardly keep up with these giant factories of thought and securities analysis and securities flogging that constitute the working groups of Wall Street. So we have to pick our spots, and those spots typically have something to do with out of favor securities. They have something to do with wrinkles in history that might seem applicable at the present moment. So that's what we're about, Trey.
So my children get a kick out of watching me write checks because they rarely see it happen. And I was watching an interview you did earlier this week, and there was one of the last operating Rolodexes in the world background of your desk. Yeah. And when I see those things, it does remind us that we're getting a little older. And my question is, how have you adjusted to contemporary markets, and how do contemporary investors, best apply the prism of your work, to things like Bitcoin?
Well, I was in the Odeon restaurant. I'm not sure if you know, it's on West Broadway. The other day, and I was there first in the early 80s. And I told the maitre d', the less you change, the more I like it. And that's okay for a restaurant, but it's not so good for the adaptive world of finance. Everything changes all the time. I think I am a little bit susceptible to nostalgia, I must admit. Being 78 and a half, I suppose that comes with the territory. Also, I write about history and do some biography in my spare time. So nostalgia must be the least repaying emotion one can bring to the office in the morning. So So the trick is to recognize the truism that markets change, always adaptive, right? They're always looking for markets seemingly always want to invent the thing that you've never heard of, just to confound people of a certain age. And the trick is to recall that is the way of markets, and yet to recognize that the human beings adamantly refuse to change. We insist as a class of animal to buy high and sell low. That seems to be in DNA. And we are highly susceptible to the thing that worked last and to the shiniest thing. And we're most impatient with people, shall we again, we say of a certain age, saying, yes, but don't you recall that, or haven't you spent enough time in the public library to realize that you were sounding just like John Law?
Mm-hmm.
Yeah. So my job is to convey that observation that many people do just sound like John Law, especially people in the White House these days. They talk about monetizing the nation's assets and borrowing heavily against those undoubted values, and treating and turning those assets into a liquid form of monetary value that can be spent. And wasn't that more or less what happened in the early 18th century in France, and then again in Britain at the same time? So the idea is to look and see what is going on, to judge whether it is sound, unsound, or something in the middle. If it's something in the middle, to ignore it. If it is compellingly appealing as an unrecognized value, no, that's exciting, rare enough as that is these days. And if it stinks, to that's good too. That's a short sale. That's we like to do that. We had a most remarkable intern last summer, Willem de Mol van Otterloo was this famous, name that goes on and on. And he is a British college student, and he proposed a story about an obscure exchange traded fund listed in London that had in its portfolio all these Russian stocks that had been condemned and deplatformed, and you weren't allowed to say their names out loud in some quarters of polite society. You're certainly not allowed to own them and trade them. But this thing has gone ballistic since Donald Trump came in and has been talking nice to Russia about peace in Ukraine. So and then mind you, that's for the intern. You want to see what the regular guys pick up. So we try to be constructively different, not different for the sake of being different. My goodness, we don't need that. There's enough weird stuff out there that is unrepaying, but we try to, as I said, to think of how we can help our readers by imagining something different and profitable and unexplored. And every once in a while, we can do that. My favorites, this is, I don't know, I think there are maybe things that help more people than this, but my favorite examples would be a story that ran out in 2006 under the headline "Over the Cliff with Morgan Stanley."
Mm-hmm.
And I got such a kick out of writing that, and one shouldn't. It is unchristian and usually unprofitable to indulge in Schadenfreude. But 2006, 7, 8, and 9, and indeed 10 were no picnic even for the Bears. I must say, Trey, that I didn't mind seeing this rather self-regarding white shoe institution that was running leverage on statement dates in excess of 30 times get its comeuppance for holding the assets it did when everyone else was doing exactly the same thing.
Mm-hmm.
So I think despite the advancing age of its editor, grants can these marry these different things, hire the right people, which we do very infrequently because nobody ever leaves. But again, it's a case of I think is if I had to pick one word, it would be imagination.
Mm-hmm.
Imagining what could be different based upon what has actually happened.
Mm-hmm.
And Trey, I want to change the subject. This is a bit of a vanity project so far, but it ought not to be. We ought to think about the people who are watching. So it's what you do too, right? So
Right.
both of us, I think, are in the somewhat culturally difficult position of recalling to the memory of our respective audiences a monetary asset that actually, little known fact Trey, is that I personally invented gold bullion.
Mm-hmm.
Yeah. And you were right there with me. I must say you were right. I think you invented silver or something.
Mm-hmm. Well, you mentioned 2006, and that's a good segue to a question I was going to ask you about today's market environment and the concept of an everything bubble, which is a term we've read a lot about. I was lucky enough to catch a discussion, of the great Howard Marks recently, in which he pointed out that in his 50-year career, he's successfully spotted about 5 bubbles, and that it
Oh,
doesn't
that's
happen
nothing.
every. Yep. And he points out they don't come along often, and the key is
No, they
to try to.
don't. That's not to say you can't spot them.
And the key is to figure out, how to spot them.
Yeah.
And he points out that in 2006, the period you were talking about, he was not particularly up on the details of subprime mortgages in that part of the world, but he was up on the fact that things were happening in the part of the world that he understood of credit that were crazy, debt covenants, that type of thing, that people were literally behaving in a
Yeah.
crazy fashion. And he raised a bunch of money in '06 and prepared for the eventual 2008 opportunity, which happened to be subprime mortgages. But in reading your most recent issues, it struck me that you've talked recently about 2 parts of the financial landscape, which are, debt facilities that are underwritten exclusively by NVIDIA GPUs. And in another issue, you talked about the new world of, DeFi shadow banking system. And I was wondering if you believe, a la Howard Marks, that these 2 parts of the economy are getting to the point where people are doing crazy things, in pointing to the fact that we may be getting close to a situation where an everything bubble is
Yeah.
reaching the end of its run.
Well, I'm rather hoarse with saying so. So yeah, you know, let me just say that our timing has not exactly been pinpoint over the course of 42 years at all times. We've had some coincidences when our time was exactly right. Everyone says, "Wow, how did you do that?" I said, "I don't know. It was a mistake." But
Mm-hmm.
generally, if something is big enough, if it's problematic enough, and if you are alert enough, you see it long before it really matters. That's been our kind of our bane and glory. We started getting bearish on the house price thing in the year 2000. No, that was not 2006. We started. House prices got out over their skis in 2000, 2001, especially 2001, 2002. And the elapsed time between 2001 and the payoff in 2008 and 9 was a lot longer than 7 or 8 years, I can assure you. It felt like forever. So as to the present day, there is every sign of rampant excess in the in this crypto business, and Bitcoin. I speak as if this were a second language, the crypto. It's not. Um, I'm like an American rolling around Paris with 4 years of high school French under his belt. Uh, so there are people here. James Robertson knows a lot about it. Evan Lorenz knows a lot about it. I know very little. However, I do recognize the signs, classical signs of speculative excess. One recalls, we certainly recall, the arc of overbuilding and overspeculation that characterized the years leading up to the dot-com bust in 2000, 2001, right? And we think that these data centers are tracing out much the same pattern. We think that the supply is running greatly ahead of reasonably expected demand. And there was remember the 1 day panic a couple of Mondays ago when it turned out there was a Chinese biosimilar for data centers that cost like 50 cents, and these guys are spending tens of billions of dollars. Well, that lasted literally for 24 hours, but we think that the market was onto something that panicky Monday. People don't, there's so much money invested now. I think we're not exactly receptive to the proposition that the spending might, or much of it might be redundant. And the thing that I would suggest by way of a kind of a practical financial thought to our viewers, because I think our audiences overlap, Trey. You're an exceptionally perceptive student of the metals markets and indeed of all financial things. And I think perhaps one homely piece of advice with regard to these payment platforms, the ones that have all the cute names that might be seen on the stern of a sailboat, Pancake Square. I don't mean to single them out for bad financial practice, but my goodness, some of these names are exactly 180 degrees away from the name First National Bank, right? That's not what they're doing. These payment platforms specialized in very quick execution and highly advanced customer relations that make you feel as if they really want you to be in their platform. And the younger people, I think especially, want to feel as if they're a part of a community, want to feel smart. They're not being judged for their finances. And they keep a lot of money in these platforms as if they were banks. And the numbers show that, billions and billions. And what these depositors should know is that they're not FDIC protected. Simple as that. And a professor at Cornell, Dan Awry, Awry, I think, wrote a book called Beyond Banks. Last year it came out, Beyond Banks. And in it, he describes the very different customer experience between being caught in a FDIC resolution on the one hand and a corporate bankruptcy on the other. And if you are an unsecured creditor of a payments platform, your fate come a bankruptcy is a very long wait in a queue in which you will not be the first to seek your money back. So just beware that along with the advantages of so-called decentralized finance, which increasingly is becoming centralized, by the way, along with the advantages come the essential drawback of having your money outside the pale of federal protection. Some libertarians might say, well, that's what I want. That's exactly what I want. Which to me is like saying, all right, fate, let's see what you got. No. So, yeah.
So, getting to your lifelong hobby of interest rates,
Think
I
about
think.
that, by the way, Trey, as what you just said, the lifelong hobby of interest
Mhm,
rates.
mhm.
Well, everyone needs something.
Right, but a major component, I think, of the bearish or gold camp these past 2 decades has been that 15 years of ZERP and QE are going to lead to a certain amount of malinvestment. And the theory has always been, at least in circles I reside, that when interest rates normalized, a lot of that malinvestment would flow to the surface. And I'm sure you've seen the infamous Stephanie Pomboy graph of the channel of downward sloping 10-year yields since 1981. And each time there's been a market backup in 10-year yields, there's been a swift financial dislocation or crisis. And recently, 10-year yields have clearly broken out of that declining channel, and we've been out of that for 2.5 years, and yet we simply don't get that malinvestment that we would have expected flowing to the surface. So I'm interested in why you think that's the case.
Well, I would say patience is what's called for. I think it's happening. We're having a conference at the end of April on distressed investing. And our conviction is that with respect to interest rates, that where they have been is nearly as important as where they are going. And by that I mean the dozen or so, or 15 years, whatever it's been, since 2000, I guess in 10 is a way to start the business of QE. And there were some fits and starts along the way, but there's a good dozen years in there of suppressed rates, and suppressed rates give us misdirected capital. They give us misperceived risk, and they give us inflated values. And that's not a very healthy combination of things to be present simultaneously in our financial affairs. But lo and behold, they are. And I think that I agree with you. You wonder if you're of an Austrian frame of mind, which I gather, certainly I don't have to gather, I read your stuff, I know we both are. And you wonder, like, where is it, right? Where is the consequences of these dozen years of misdirected capital? It's like interest rates are the traffic signals of a market economy. And it was green for a dozen years, and you expect all sorts of pileups, intersections, and various troubles attendant upon the lack of smooth flowing and rationally flowing traffic. But I think that this stuff is upon us, and it has to do in part with meaning the consequences of a dozen years of suppressed rates, have something to do with the state of the public credit, because the Fed cuts its funds rate, and yet longer dated yields rise. 10-year yield was 4.5, and few expected it to return to 4.5 from, say, 3.80, but here it is. And that is testing the balance sheet strength and an endurance of commercial real estate speculation and investment. It's testing the endurance and balance sheet strength of a host of private equity promotions. And it is testing the balance sheet strength and endurance of many, many regional banks and community banks that bought the Fed's line that the interest rates would be very low for so very long. And don't worry about when. We'll tell you. They didn't. So I think that a lot of this stuff lies ahead of us, and there's long cycles of credit and rates, and I think that I'm not ready to give up yet on the Austrian expectation for some resolution that will lead to, let us not forget, the opportunity that comes with distress. I don't think either one of us necessarily is involved full time in the Schadenfreude line. I must admit to it. It's just sometimes. But the whole idea, to me, perhaps you differ, is holding gold is you want to be liquid. you want to have an investment to be sure in monetary disorder, which I think that to me that's what gold is. But to what end? To the end of having cash and courage when others are short of both. That I think Irving Fisher had had a wonderful epigram that he said, if I can do this justice, the purpose of a capital asset is the means to the end of a thing called income. And gold pays none. However, owning it at the right price for the right reasons, in the right cycles, in the right era, is an indirect, but I think true means to the end of income.
Well said. So you mentioned the Fed cutting rates, in September with, GDP at 3.1 and the dollar strong, etc. The Fed saw fit to begin to cut rates, pretty aggressive 50 basis point cut, and then cut rates 100 basis points in 3 months. And since then, 10-year yields at one point in mid-January were up 120 basis points from first cut. So Goldman Sachs informs us that that is the steepest increase in long rates ever following an initial Fed rate cut. What do you think that's signaling?
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to Wealthion.com and sign up for a free no obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.